Hello, can you hear me?
Yes, I can, Emma.
Fantastic.
Thank you.
Welcome to our webinar. Today we're going to review the most common funding and finance options for innovation that are available to you. And my name is Emma Fadlon. I don't seem to have control over the presentation now, so someone's going to have to move on for me. See if it works. Oh, I have got it. So my name is Emma Fadlon. I'm in the Access to Funding and Finance team. I've been with the KTN for coming up to 4 years, and I work with early stage companies that are, for some reason we've gone forward one. Can we go back one, please? Who's driving the presentation?
Sorry, Emma, it's not me.
Yeah, we're going in the wrong direction. Can we move the slides, please? Thank you. I work with companies that are working on early stage investment, typically up to Series A. And I'll introduce you to my colleague, Charlotte.
Hello, I'm Charlotte Thompson, also in the Access to Funding and Finance team. I live in Sheffield and predominantly work with companies in the north of England and the Midlands in helping them prepare for innovation funding and finance, and mostly that being within investment.
Okay, so moving on to the next slide. Okay, so we're going to review 4 areas of external funding. We're going to look at grants, debt finance, sort of crowdfunding and investment. And I'm going to hand over to Charlotte for this first few slides.
Great. So there are 4 main ways of funding a company. You can use profit from sales, receive a grant, borrow money, or receive investment. And borrowing money or receiving investment can be from traditional sources or from the crowd. So debt is a loan that needs to be repaid within a set time frame, usually with interest. Equity investment is a share in the company provided in exchange for the investment, and interest is yielded through the increase in share value. Or through grants, and that is usually provided by public organisations that is non-repayable. Next slide. Yeah. So sales are often looked at as a source of finance for a company. You take the profits you make and you reinvest them to develop the products and services you offer. You are, of course, in complete control, but generally you will grow more slowly. The motivation for requesting other sources of funding is that you wish to accelerate the speed in which you can develop and grow your company. Next slide. So grants are non-repayable funds offered by a range of organisations, which are typically government or public sector, and they have a number of purposes, from encouraging new collaborations, driving solutions for a particular challenge, promoting innovation and the development of new products and services, or for de-risking a project to a level where they become feasible for companies to take on themselves. Grant providers usually require some kind of innovation. There are some exceptions. Next slide. There are many advantages to grants. They generally accept a higher risk of project failure than traditional finance, and they can be used to indicate credibility due to the high quality threshold required to receive the funding, and also because they can be highly competitive to win. And this is particularly useful when seeking other finance, such as investment or banking, where a grant can be used as leverage to de-risk a project for that private sector. On the con side, grants are rarely 100% funded. Generally, the larger they are and the closer to market the grant output is, the less that you receive. So typical contributions are 25 to 75%. Smaller companies tend to be given a higher rate than large companies, and therefore you'll need to self-fund or seek funding of that grant. So next slide. So you should think about the motivations of an organisation giving a grant, because understanding the motives will help you decide what grant is best for you, and also making sure it is aligned with your business objectives. If the funding organisation and your business are aligned in your objectives, the higher the chance that you'll be successful in applying. So on a geographical basis, if we look regionally, there are grants available through locally. In England, this is through the local enterprise partnerships and growth hubs, or in Scotland through Scottish Enterprise and Highlands and Enterprise. Wales with the Welsh Government, and Northern Ireland through Invest Northern Ireland. Equally, you can also sometimes see pockets of innovations vouchers available, sometimes facilitated by local universities, and that's usually about 5k to work with third parties. And then on a national level, through the likes of UK Research and Innovation for innovation and research funding, but also through other national bodies like Nesta for social impact investing, and the likes of Wellcome Trust for health. So look at different trade bodies and associations aligned with your company. And then on a European level, it's worth talking with the Enterprise Europe Network and our UK national contact points to learn what current funding is available through Europe. And then on an international level, and perhaps some more sector and technical nuanced funds, there's a funding scheme called the Small Business Research Initiative, which is a pre-procurement process where you work with a customer to develop the product, or through charities and international funds like the Newton Fund. Next slide. So when sourcing grants, it can be a very time-consuming process. So it's worth speaking to your local enterprise partnership, European Enterprise Network, or the Knowledge Transfer Network, who can provide business support and hone down the right one for you. And think about accessing funds not just generally from the usual culprits, but think about it from a local, regional, national, European and global perspective, but also whether there are any grants for any particular sector or technical themes associated with your company. Generally, the more local the funding, the less competitive it tends to be. So bear that in mind in terms of the type of funding you're looking to access. It can take quite a long time to write an application. I think it takes about 2 weeks to write a good application spread out over a couple of months. And make sure that before you even start writing that application, you read the scope and eligibility, because it takes such a long time to write an application that if it's not right for your business, then the chance of success will be limited. You can use lots of online tools to support you in finding the right form of grant, whether that through the Innovate UK funding webpage, the Horizon 2020 participation portal, or through free online searches like Grants Online, or subscription-based online platforms like Grant Finder. So that's some of the pros and cons of the different types of funding you can find through grants. If we look at debt finance involves borrowing money to be repaid plus interest. To be honest, there aren't a huge amount of debt finance options available for early stage companies who are pre-revenue, who don't have a strong track record. However, I will go through a couple that are applicable and some of the terms associated with those. So why debt finance? If we go on to the next slide, it's cheap in that you're not looking to sell shares in your company. And they can be flexible in terms of the terms and the duration in which you pay back that loan. The disadvantage is that decisions are usually made by a computer and it's not part of negotiation or ability to be able to go back. So they can be quite hard to achieve from an early stage perspective. And equally, when a company is struggling, that tends to be a time when the loans are called in, which especially with an innovative company and when that journey is very much a roller coaster ride, debt finance is not really always appropriate to manage those lumps and bumps. So what is applicable? On the next slide, I highlight a couple of these, one being startup loans facilitated by the British Business Bank through its partners, and innovation loans through Innovate UK. And I've got 2 slides on those that I'll go into a little bit more detail. Equally, you can find debt finance options through the British Business Banks, where they also provide case studies of peers who have already been on that journey, and you can learn from what others have done and see what might be right for you. Equally, debt crowdfunding platforms like Funding Circle are a good way for small amounts of funding on a short-term basis. So startup loans. Next slide. Startup loans provide 25k per director, up to 4 directors, providing up to 100k per business. They're on the back of a business plan, and they're probably the shortest time frame in terms of being able to get finance into a company, especially in comparison to the timeframes associated with accessing grant funding or investment. It's at 6% per annum, fixed interest rate, and the repayment period is flexible up to 5 years. Equally, it provides 12 months along that journey. And I've provided a link there, and I'll provide a link, a handout afterwards with various resources associated with all these different programs that we're talking about. And the next slide on innovation loans, provided by Innovate UK. This is 100k to £1 million for late stage R&D funding all the way through to commercialisation. You can draw down the loan over a 3-year period, whereby you carry out your late stage R&D project, and then you have up to 2 years to then take that product through to commercialisation and then start to repay that loan up to 5 years. There is currently a live competition for this that closes at the end of November, so if this sounds like it's ideal for you, then please reach out and we can have a chat about this in a little bit more detail. So that's it from a debt finance perspective. Over to you, Emma, on equity investment.
Thanks, Charlotte. So simply, equity investment is where you're selling a part of your business on the potential of that business to give a return on investment. And you have to keep in mind when you think about investment, about what investment an investor is looking for. And it can be all sorts of different interests. It can be personal interest. It can be, they'll have different risks that they'll be willing to take, different times on the return of the investment they're looking for, different types of relationships maybe you want to be having with the companies they're working with, and also some of them might be more interested in various sectors. So what are the pros and cons of investment? Well, typically when you get an investor on board, you get more than just the money. You hopefully are getting investors who are interested in helping the company grow and develop, opening doors for you, and also helping you grow and develop. And you should always be looking for investors who are willing to work and support you and your team. Also, investors are taking on the risk because you are still selling the potential of your business. You haven't proven necessarily your business can grow and succeed, give that return. But the negative side of it is that you are going to have to give a share of your business, and the share of the business is going to be linked to what your value is at that point in time. And that is going to be linked around what traction you've got. So how far you've gone around proving your technology and the market and commercial opportunity. And the other challenge with investment is how you're going to transition between the different rounds of investment. And it's really how, as you're growing your business and you're de-risking it, but there's still certain risks, and the risk appetite of investors, as we said, can vary. So this is a typical sort of investment journey just for you to look at. So usually when you've got the highest risk and you require a amount of investment is at that startup phase. Some of you may look at bootstrapping, which is where you'll fund it yourself through your savings, credit cards, and whatever other ways you can get money into the business. And then you may be looking then to get your first round of investment, which will come from an angel investors. And we'll talk about them in a little bit more detail later, but that's somebody who's putting their own personal wealth in there. And that can be from friends or family or contacts in the area who are interested in what you're doing. As you start growing your business and you start having different proof points, then you're going to move into what we call the venture capital phase. And that's where you're going to get sort of more corporate investment coming in. And that's typically when you're looking at the 1.5 million. And then the last stage of investment is when you're looking to exit, and that could be through the trade sale. This is typically when angels and VCs may find their return on investment, or depending on the size of your business. And you can also float on the alternative investment market, and that's where you bring external sort of pension fund style funds into your business, but that's highly regulated and much later down the line. If you're interested in the IPO and what that looks like, there's some fantastic resources on the London Stock Exchange, and they actually explain how that works and what the regulations and finances are. It's a good read, so it's definitely worth having a look at that to understand what it means. I seem to have lost control of the slides now, so could somebody move me on to the next slide, please? See if that works. Thank you. Talk about angel investors. So typically the first investors you're going to bring into your business, and they're individuals who are investing their own personal wealth, and they are going to take equity in return for the share in your business, but also they're very likely to introduce you to contacts they've got, provide you some business advice, and they're quite variable. A typical angel deal is usually around the 100 to 500k mark, but some deals, particularly in syndication, can be much larger. And 8 out of 10 deals are done through syndication or through clubs. So you need to think about finding a lead investor who can introduce you in, and thinking really about what they're looking for and how they behave. Some angel investment groups will actually behave a little bit more like have to maintain and look after those investments in their portfolio. Angels typically are very patient, and they will invest alongside VCs with grants or crowdfunding, and they will not expect to see return on the investment within the next 5 to 7 years. And the reason being is that they understand really how long it takes to grow a business when they're investing you at a very early stage. But they can vary, and it's worth having a look at the UK Business Angel Association guidelines around that. So I still don't have control, so I need somebody to move my slides along. So why do angel investors invest? Well, they like to invest in companies because they enjoy it, they enjoy helping companies, and also there is a tax break for them, and that's the 2 schemes around, which are the Seed Enterprise Investment Schemes and the Enterprise Investment Schemes. They're both government-backed programs, and if you're not aware of them and don't understand them, then do have a look at the website, the government website, and we can always have a chat and talk you through that. As I said, quite often angels will also follow on invest at the very beginning when you're still very high risky. So it's important that you have a really good relationship with them, keep them informed, and work with them. So the next type of funding we're going to talk about is venture capital. And this is for companies at a later stage, and you've got some proof points, you may have some traction with some early customers. And we're looking around the 1 million, 1.5 million, 2 million mark is kind of the entry for a lot of early stage companies we work with the VC. Why do VCs invest? Well, the VCs are typically looking after a portfolio of companies. There may be thematic portfolios, and they're looking to build a portfolio of companies for the value of that portfolio. As a result of that, because they're investing other people's money, and can be pension funds, it could be corporate pension funds, it could be other investment pots, they will do a lot more due diligence than maybe an angel investor will have, and they'll also look to have a different sort of control over the company. So there will be sitting on the board, and they'll be monitoring, and they may actually want to. And this is where you have to think about your funding journey, what sort of relationship you're going to have. Typically, a VC is going to look for return over investment within 3 to 5 years, but it depends on the sector you're in, and certainly if you're in life sciences where it takes a lot longer, or in engineering, then they know they're going to be working with you for longer. Some VCs have some very interesting funds where they will want to be the lead investor at that very early stage, and will put all of them in and then will provide you a lot of support into their networks. Others will want to be the lead, but or others will want to sort of follow another lead investor, particularly if it's a very technical sector, which they may not be experts in. So I've lost the control again, Shuan, so you'll have to move me on to the next slide, please. So what are the objectives of a VC? Well, as I've said, VCs are investing other people's money. So they're looking at it as a stock-centric investment. So they need to be able to monetize that portfolio. They will have a portfolio approach quite often to investing, and they will be wanting to manage the risk within that portfolio. And one of the things I would say is to have a look at what sort of fund, VC fund it is. Is it an evergreen fund? That means one where the funding keeps going in and they've got money to invest. Is it a 10-year fund? Some of the funds, which might be linked to family trust, will give you the first $1 million of investment, but are sitting on 5. I've done up to 20 million that they're willing to invest into a company as it grows. So you need to understand a little bit about what their objectives are, how you fit into their portfolio, have they made other investments that are risky investments in your sector? Is there an appetite to do more investments in that area? So get to know your VC, start building a relationship with them before you're ready and looking for investment with them. They will be tracking you, track them, understand what they're doing. A VC relationship is going to be a long relationship and they have a lot more control over your business. So do think about how you're going to manage it. They cash, well, they can sell the portfolio of businesses, another holding body, or they may want to float that on the alternative investment market. See those companies floating, or put together, aggregate some technologies together. I've seen that happen in certain areas. Oh, this has gone back too. So the next thing we'll talk about is corporate venturing. If you can go back, please. We seem to be going. It's coming back. Corporate venturing, thank you. So corporate venturing is a VC investment where the corporate will be investing in companies that are of strategic interest to them. And so they're not necessarily looking just for a return on investment. Some may be the leads, but quite typically in a invest and follow and invest, but not want to be the lead investors. The motivations for corporate venturing can be quite broad. So if you look at somebody like BP, it can be anything from how you're moving all around globally in containers, through to processes and systems that make their business and their relationship with their customers more smooth. So it's not always obvious what they're looking for, so it's definitely worth exploring. Where can you find good information on corporate venturing and VCs? We'll have a look at the British Venture Capital Association Guide to Corporate Venturing, and also some of the VCs, corporate VCs will have their own sites on the internet, so you can do your research. Next slide. As we said, one of the ways in which you can raise money is through public flotation. Quite typically, it's floating onto the alternative investment market on the London Stock Exchange. And if you're going to do that, it's really can vary on how long it takes. It's quite an expensive process. You will have somebody assigned to you who will work with you and make the introductions into the investors. They're typically pension funds. Sometimes it can be large family trusts and other VC funds. And you'll get an aggregation of money. And typically, I've seen that used by companies where they've got good customer base, they're growing, and they maybe want to sort of grow and expand, and they've got a really very clear route to market and expansion. Can sometimes depend on the fashion as to what people are interested in actually investing in on a public flotation, but you are controlled and managed in a completely different way if you do go into public flotation. So moving on to convertible loans. So one way in which you can get money in where you can sort of hedge your bet, so to speak, is to have a convertible loan. So this is where an investor provides a loan which has a maturity date and interest associated with it. And at that maturity date, the investor has a right either to convert the loan into equity, or you have to pay that money back with the interest. The great thing about a convertible loan is if you think your company is going to grow and scale a lot more quickly, and that you've been valued in a way that you think is undervalued or not appropriate for your growth plans, then it's a way of actually saying, well, give me the loan, and then you could convert it at that rate at that point in time. And you're not selling that part of your business at that early stage. And it manages the risks for both parties. Doesn't require immediate payment of the loan and the interest, but when they are converted, you need to look at what the rules and regulations are in your contract around that and negotiate around that. So it behaves like a standard loan. The investor doesn't have the rights of a shareholder, and they can be quite quick. And I found that some of the local enterprise partnership mechanisms for funding have been convertible loans, so they're definitely worth exploring. But there can be some challenges when you're going for VC funding, and also when you're looking to raise additional funding from other sources where they might see that as a risk. So moving on to moving on to the next slide, which is crowdfunding. Crowdfunding has become a very popular route for getting investment into businesses. It's very disruptive. And there are 4 types of crowdfunding. So most of you are probably familiar with the Kickstarter type one, which is a reward-based one. And it works with B2C, where you're going to be giving somebody something once the campaign sort of fulfilled its objectives. There are some donation-based crowdfunds, which I've seen used actually for very early stage technologies where there's a global good. I've actually done a donation crowdfund to a technology sector I was interested in. And then you've got debt, which is similar to a traditional debt finance, but the level of interest you pay goes into the open marketplace. So it can actually drive the interest levels down. Not necessarily government guaranteed. There was a Funding Circle, which was a British bank product at the beginning. You might get finance for high risk projects at a rate of interest which is more attractive to you than going into the banking sector. And the last type of crowdfunding we're going to talk about is the equity crowdfunding. And this is the one where you've got a platform that will show all of the collateral supported for you. So all of the terms and conditions for the shares, all the agreements are all standardized, so that everybody who funds in knows exactly what T's and C's they're signing up to. You'll need a business plan, you'll need to have the appropriate marketing collateral for that, and you must remember that you can't promote your crowdfunding to anybody. The people who put the money on there must be people who are either high net worth individuals or competent to be able to make a decision on whether this is a good investment or not, because they are knowledgeable about finance. So be very careful how you promote it. There are certain legislations around that. So moving on to the next slide, if I can move that, yes. So typically now, what we're finding, and this is kind of some data, it's a couple of years since January, is that if you look at crowdfunding overall, certainly the equity-based crowdfunds, you need to have had about 25% of your investment sort of signed up and guaranteed before they'll allow you to go onto the platform. That seems to be the tipping point on the success rate. If you look at them overall, 80% of campaigns were failing. Unfortunately, that can mean that some sectors, some areas are a little less highly supported by the crowdfunding platforms. But there's some very good resources out there. If you have a look at any of the current ones that are running in the UK now, they're really, really useful. There's some very useful resources, and there's some very useful guidelines as well, and overviews of what sort of things have been invested and been successful. So don't rule it out, but think about how that fits into your overall funding journey. And so moving on to the next slide, the pros and cons. As we said, there are hundreds of platforms. So where do you go and find them? Well, some of them are sector specific, some of them are generalist, some of them are for earlier seed stage, some of them are for later, some of them will want a higher percentage of money sort of investment secured before they allow you on. Some of them will need a lot of marketing collateral. But there are lots of options for you, and you might find the right one for you. And it's actually a way of proving your market, specifically if it's the right sort of B2C sort of investment or funding that's coming into your crowdfund platform. And it's a very good way of validating and adding credibility when you go into the follow-on rounds. But I would suggest that you really think about having a lead investor with a crowdfund nowadays, if you're going for an equity crowdfund, and think about how it's going to fit into your subsequent funding rounds, because some investors don't like crowdfunds, others do. So make sure that if you've got a funding strategy, you discuss it with any potential VCs for later on down the line. So moving on to the last slide in this series, we're going to talk about is accelerator programs. So this has been a really interesting program set up by Innovate UK, where they're matching grant funding to equity investment from a very, very nice program where investors are invited, who have got money to invest in a particular sector, are invited to express their interest. Innovate UK will then bring them on board. Those investors will then look at what sort of technologies are around in that area, and if they're interested in investing in them, and the company can apply for the grant application. If they pass the Innovate UK grant process, which is the standard grant application, then you get the grant, you get the equity investment under that competition and call. And what you're going to get is thematic supported programs, and you'll also get the support of the investors who are more likely to want to follow on fund and invest. You should also look at the accelerator programs as in accelerators where they are thematic early stage technology spaces. So these accelerator programs are usually funded by private sector funding, and they can be general or thematic. You'll see them all over the country, some of them being supported by banks. What you'll have is a safe place to test and grow your value proposition, work with other entrepreneurs and work with experts in your field. Typically an accelerator program will give you around about they'll give you some investment of say £50,000 for something like 5% of your business, and then you'll have access to the networks for a period of time, 6 months, 12 months, and sometimes longer. As we said, they're both thematic or general accelerators, and these have been very successful. You'll see them around. They're popping up all over the place. Nest, on behalf of Innovate UK, did a really good overview of them. So if you look at the website, the Innovate UK website, you'll be able to see a list of the different accelerator programs around the UK. So I'm going to move on to the next slide, which is, this is an overview, but what you need to do is you need to think about your funding and finance journey and make sure you've got a cocktail of funding, that you get your grants in there, you get your regional support, you look for any international support if that's part of your route to market, and that you think about how much money you need to reach those technical milestones and to plan your funding and finance journey to your business plan. So on to the last slide. So we're opening up for questions, but before that I'll say, Charlotte, is there anything I've missed?
No, that was great, Emma, thank you. I guess whenever I'm working with a company, I always think, actually, how much money are you looking for? What are you looking to spend that money on? So you've got like a shopping list of things that you're going to spend the funding on. And then how is that actually going to transform the company? So what significant milestone does that achieve? And then think about your preferences for the type of funding, like Emma was saying, around grants, equity and debt, to see whether actually if you need £1 million worth of funding in order to reach your next big milestone, then actually could half of that come from public? So think about it as being a blend. So yeah, thank you very much. Xuan and Poonam, I don't know how you want to manage the Q&A from the live workshop, and also those online. I'll also be taking a look from the chat bot and the Q&A if anyone online would like to submit any questions.
Thanks, Charlotte and Emma. Is there any questions in the room about funding or finance?
Just where you talked about the tax breaks for the SEIS, and what does that look like when you do? Do we have to be aware of that, or is that more from the company side?
Did you catch that, Charlotte, Emma? So tax for SEIS.
Sorry, can I just understand who's asking the question?
Hi, my name's Frances Trout, and I run a work experience business that focuses on creating opportunities for students.
Okay, great. So it's a tax break for investors. But it makes companies that are eligible for these tax breaks, makes them far more attractive. So the Seed Enterprise Investment Scheme is up to 150k maximum into a company, and the Enterprise Investment Scheme is up to £1 million or £2 million if you're a knowledge intensive company. It's facilitated through HMRC, and you can check out the guidelines on there and on the gov.uk website.
The rules are changing in April 2020, the next financial year. The rules were made to be more generous, taking into account that they wanted to get more money coming into the ecosystem. And the Enterprise Investment Scheme is it's a non-governmental body, not for profit. They have got some really, really great resources and provide support as well, both to companies and to investors around the schemes as well.
Okay. Does that answer your question?
Yes, that's fine, thank you.
Brilliant.
Is there anyone else in the room with a question? I'll come back to the room in case you think of anything in a minute. So I've got one that says, I'm the founder and management consultant of FundKB. I want to understand how to fund for projects that take several years and stages to develop, and I have potential customers who are in the health industry.
When the healthcare, and if it's a healthcare innovation, then the investors that typically invest long-term know the time that it takes for the technology to develop. They know the challenges around, sort of particularly around public sector customers and the sales cycles, and the time proof points to adoption. So without knowing where exactly you sit in the market, having traction, proof of traction and potential collaborators and investors is really great. I would try and leverage in as much of the public funding that you can, and don't just look at Innovate UK, look at things like Public Health England and National Institute for Health Research and the other NHS funding routes around that. Try and get as many sort of customer sort of proof points, user journeys, case studies as you can when you're speaking to the investors, and understand which are the specialist investors. I mean, it's very typical. I mean, most healthcare, you're looking for multiple millions, and you're looking for 10, 15 years before they're going to see the return on investment. So those investors will know what they're looking for, and they'll know what sort of risk appetite and what the potential is. So they tend to be good ones to work with because they really do know the marketplace and add a lot more value than just money. And it's worth looking to see which investment areas and themes they're interested in supporting. The corporate ventures are also very useful. So definitely worth having a chat with them and understanding at what point they would come in and invest if you fit into their portfolio.
Thanks. So I've got another one online. It says, I'm the founder of an early stage ed tech company focusing on critical thinking and reading development in young people. There is thus a strong element of social impact. Are there funders you would suggest to help early stage research, understanding user needs and iterating through different prototypes?
I think there's quite a few options and programs that might be applicable. So a lot around feasibility study, that understanding the user groups. There's a program called run by Innovate UK, and it's worth checking that out. Equally, by considering putting in a feasibility study through something like Innovate UK Smart Programme. There's also a lot of investors within the social impact space, and like the likes of Nesta as well are worth considering. But if you'd like a more of a deep dive just on your business, then please feel free to reach out to Emma or myself, and we can kind of go through it in a little bit more detail.
The other thing I'd say with ed tech and early stage research, it depends how early stage it is. And if you can, then you might want to look at maybe doing collaboration with an academic group and seeing what sort of funding you can get through those routes. Some of the universities also have sort of funding and support for early stage companies, certainly on business growth. But you can get access to support, and also look at the charity sector and what is available through the charity sector if you've got particular users and needs, and that can be really quite useful. EdTech, you know, when you're talking about sort of the early stage research, it's really understanding how early stage is to be applicable to sort of commercialization funding. You want to make sure, if you look at the Innovate UK, that you've got a risk element to your applications, but you're not too early stage. Otherwise, you won't be eligible for the things like the Smart Awards. So when you use the word early stage, make sure you qualify that.
Are there any more questions in the room? Not at the moment, but I've got another one online. What proof would an investor need to see that a company seeking funds is eligible for SEIS or EIS?
So you used to be able to, Emma, you have to, the term's not on the tip of my tongue, something assurance. What's the word?
Well, you can get pre-assurance with CIS. So basically, there are certain sectors that they absolutely don't invest, don't support. So I think it's oil and gas and things like that. So you need to be in trading for a certain period of time, and not marketing your product for more than 7 years for a start to be eligible for EIS. And then you can't raise more than, I think is it 5 million per annum, and you have to spend that money within a certain time frame as well. So depending on how much investment you've got already, what sector you're in, how long you've been trading for, or how long you have been selling your product, sort of are all factors. But generally the companies we work with, which are early stage technology companies that have only been around for a short period of time, then they all tend to be eligible. You can get pre-assurance. It takes quite a while, and sometimes it's easier to actually do it when you've got an angel investor on board as ready.
I think you have to name an investor now, because the sheer volume of companies that were applying for pre-assurance.
So that was a change that came through. I don't know whether that's changing again with the changes in 2020, but what I will say is with the EIS is, you know, a good accountant can help you with that as well. So when you're looking at your finances. And another thing that I learned is that if you are a business that's pivoted and you are looking to get investment into the area where you're pivoting, you're changing your business model. So I saw a company that was gone from basically a service model to a software as a service, and they're opening that as an opportunity with some research into a new sector, that particular element of what they were doing and the internationalization, they were able to get EIS investment, but the rest of the business wasn't eligible. So there are some little caveats as well. So if you kind of think you fall outside because of timeframes or the sector you're in, there might be elements of what you do that might be eligible. But by and large, it's you need to have your investment, your original or your first investment or investor on board to to get that assurance.
Yeah, so don't let it put you off from not going out there and engaging with the investment community. I think it's just to make sure that you understand what the tax breaks are for them, and that you've read the criteria at this stage.
Is there any more questions in the room? No? Okay. So I've got no more questions online. So I'm going to say thank you very much to Charlotte and Emma for all your insights. And I'm just going to run through a couple of things that we've got coming up. So obviously, Women in Innovation Programme. As part of such, we are running 3 more webinars are actually already up and ready to register for. One is on the 27th of November, and that will be around public relations. One is on the 10th of December around social media, and on the 17th of December around financial planning. You can also join the Women in Innovation newsletter via the KTN's website. We also have an online community with a number of resources on there, and an opportunity to network amongst yourselves. And that is on our World Labs platform, the link that you can see. And if you have any further questions about women in innovation, or you want to get in touch with somebody directly, my email address is there as well. And please feel free to reach out. And I'd just like to say thank you to everybody that participated today. Thank you to all the women in the room here. And thank you to Emma and Charlotte.
Thank you.
Bye.
Thanks.
Thank you.
Bye.